All right, let's dive into the latest quarterly results from industrial manufacturer Worthington Enterprises. They just dropped their Q2 numbers, and honestly, it's a really fascinating look at how a company can find growth even when the whole economic picture looks a little cloudy. So let's break down exactly how they're pulling it off.
And that really brings us to the central question, right? How does an industrial company not just survive, but actually thrive in an economic slowdown? Well, Worthington's performance this quarter is like they've written the playbook, and we're going to go through their strategy piece by piece.
Okay, so first things first, let's hit those headline numbers. Even with their own management calling market conditions mixed, which is usually code for tough, Worthington still managed to deliver a really strong quarter that totally beat expectations. And wow, when you look at the numbers, what just jumps out at you is the consistent year-over-year growth across every single key metric. Net sales shot up an impressive 19%. Adjusted earnings per share, a huge measure of profitability, that grew over 8%. And EBITDA, which is really your core operational profit, was up more than 7%. On top of all that, they generated a healthy $39 million in free cash flow. That's the good stuff, the cash they can use to reinvest, pay dividends, or buy back stock.
Let's really zero in on that top-line number for a second. That 19% jump in net sales, that was no fluke. It was driven by a combination of higher sales volumes across their existing businesses and a nice boost from their recent acquisition, a company called Elgen. But here's the kicker. Even if you take Elgen out of the picture, their organic revenue was still up over 10%. That shows some real underlying strength.
And this number right here, this points to just how profitable they've been over the long haul. We're talking $284 million in adjusted EBITDA over the last 12 months. To put that in perspective, that's up nearly $50 million from the year before. It's a powerful sign that their strategy is delivering some seriously consistent, high-quality earnings over time.
But here's what's absolutely crucial. It's how they're getting this profit growth. See, it's not just about selling more, it's about becoming way more efficient. Their SG&A expenses, that's basically all the overhead costs of just running the business, fell by 3.2% as a percentage of sales. That is fantastic. It shows incredible cost control and gives them what we call operational leverage. In plain English, it means their profits are actually growing faster than their sales. That's the dream scenario.
So, how are they doing it? What's the secret sauce here? Well, the answer lies in their core strategy, something they call the Worthington Business System. Let's dig in and see what makes this thing tick.
This whole system is built on three really clear pillars. Think of it like a three-legged stool. First, you've got innovation, creating new products and finding new markets. Second is transformation, constantly improving how they do things on the inside, using cool tech like AI. And third, you have M&A, mergers and acquisitions, strategically buying other companies to hit the gas on their growth.
And that innovation pillar, it's not just talk, it's delivering real, tangible results. For example, they're winning new orders for specialized water tanks used to cool massive data centers. Talk about a huge growth market right now. And on the consumer side, their popular balloon time helium tank kits, you're going to start seeing those pop up in Costco stores nationwide. Plus, they're grabbing more shelf space at major retailers like Sherwin-Williams and the Home Depot. Every single one of these wins comes right back to that focus on product innovation. Okay, so let's zoom in on that third pillar, M&A, because this is a huge part of Worthington's growth story right now. They are actively out there buying companies that fit perfectly into their long-term vision.
And a perfect example of this is Elgen, an HVAC components company they recently acquired. Now, Elgen added a cool $25 million in sales this quarter. But, and this is important, integrating them actually brought the company's overall gross margin down a little bit. But here's the thing, management said this was totally intentional. They're pouring money into safety upgrades and new equipment to get Elgen set up for some serious long-term profitable growth.
And you can tell management is super confident about this strategy. The CEO, Joe Hayek, said this directly on their earnings call, signaling that they see these short-term costs as a necessary investment to unlock Elgen's full potential. It's the classic playbook, right? A little short-term pain for a whole lot of long-term gain.
And get this, they are not stopping there. Worthington just announced a deal to acquire another company called LSI. And check out these numbers. LSI generated about $51 million in sales over the last 12 months and turned that into over $22 million in EBITDA. Do the math on that. That is a jaw-droppingly high profit margin of over 40%. So you gotta ask, why is LSI so crazy profitable? Well, it fits Worthington's M&A strategy to a T. They are a leader in a super specific niche market, components for commercial metal roofs. Think about it. Their products are literally engineered into the roofing systems, which creates super high switching costs for customers. And the best part? Demand is really resilient because it's driven by roof replacements and retrofits, not just the volatile new construction market.
Okay, let's switch gears for a minute and talk about another important piece of the Worthington puzzle, their joint ventures. And man, this quarter, the story of their JVs was truly a tale of two completely different markets.
I mean, look at the difference here. It's night and day. On one hand, you've got Wave, their joint venture in ceiling grid systems, and they delivered a powerful $26 million in income. Meanwhile, Clark-Dietrich, their JV in steel framing, contributed only $4 million. So what in the world is causing this huge gap?
Well, it all comes down to who they sell to, their end markets. Wave's business is tied to much more stable sectors like repair and remodeling, plus those high-growth areas we talked about like data centers and healthcare. Clark-Dietrich, on the other hand, is heavily dependent on new commercial construction, which is a really tough market to be in right now. They're facing intense competition, and it's just squeezing their profit margins.
Okay, so we've broken down the whole quarter, right? We've seen their strong execution, their smart acquisitions, and this kind of mixed bag with the JVs. So now, let's put it all together and figure out what this means looking forward.
So this is the moment, right? If you're an investor watching, you're asking, okay, so what do I do with all this information? What's the real takeaway on Worthington Enterprises stock from here?
And you can really frame this as two competing stories. On one hand, you have the bull case. This is the story where Worthington's strategy is just firing on all cylinders. They'll successfully integrate Elgen and LSI, continue gaining market share through innovation, and expand their profit margins, all while generating tons of cash. But on the other hand, there's the bear case. This is where outside forces could throw a wrench in the works. Things like a wider economic slowdown, that weakness in their Clark-Dietrich JV just sticking around, or unforeseen problems integrating these new companies. Any of those could create major headwinds.
All right, so here is our final call. Based on all the data from this quarter, our prediction for next quarter is that solid organic growth will continue, though it might be slightly offset by those M&A integration costs. We expect the stock to continue a steady climb higher because we believe the market will reward the company's excellent strategic execution more than it will penalize the weakness in one joint venture. For these reasons, we rate the stock as outperform. And as always, just a reminder that this analysis is for informational purposes only and is not financial advice.